to address the huge uncertainty that Prime Minister Modi's comments created in the last couple of days. There is not only the fear of long-term capital gains, but after the CBDT's clarifications, now there is a fear that foreign portfolio investors may have to pay up to 40% tax on their Indian investments. So we have two gentlemen joining in, Sudhir Kapadia, the national tax leader at Ernst & Young, and Abhishek Goenka, the partner at PWC, join in this morning to talk about that. Gentlemen, morning to both of you, and thank you so much for taking the time out. Abhishek, I want to start off with you. You know, what's been spooking the foreign investors lately in the last couple of days is this possibility of higher tax that they would have to pay on Indian investments. Is this a legitimate concern?
It certainly is a legitimate concern. I think ever since the law was retroactively amended in 2012, it's always had its fair share of uncertainties. Even many of the clarifications that came in terms of the 50% threshold or the 5% safe harbor came only in 2015. So you have this, 3-year period of uncertainty between 2012 and 2015. And while the committee that has been set up by the government to look into retroactive cases technically applies only for cases pre-2012, really what is creating a lot of concerns for the FPIs and the funds is what happens in that interim period, and particularly what happens on transactions where taxes have not been paid and where the concessional rate does not apply because it's an offshore transaction. So certainly very, very legitimate concerns.
Okay. Similar question to you, Mr. Kapadia. First, good morning to you. Have FIs been calling you and asking you whether there is a problem? And also, some of them may have actually redeemed their units and gone. Is there an issue of how do you collect? How does the fund collect from those investors?
Right, Lata. Yeah, thanks. Good morning to you as well. I would put it in two aspects rather. See, the first is the law as it stood amended is exactly what it stated. There was no exception for any category of indirect investors.
Okay.
That's the. I mean, you could go back and say when the new government took power, why didn't they scrap it? I mean, all those debates were done, and the FM clarified his view or the government's view. So I think we were dealing with a law which stated what it stated. There were, a lot of discussion, representations made to basically take care of situations essentially where the indirect investors were not in controlling stake, because the whole. As we all know, the indirect transfer rule really was in the context of, 2-3 transactions where controlling stake was involved. In response to that, the clarification which came is that below 5% holdings will not be affected. So my view is, I just think that the debate on this and the commentary on this should focus on, amongst other things, this aspect of control. As we all know that 5% is a very low threshold for determining control. So my view is that if we really can persuade the lawmakers to look at it in the context of what control means, which has to be a minimum of 26%, then that one aspect can be clarified, in my view, quite easily and quite effortlessly. The second point which I wanted to make is I am a bit intrigued by the timing of these clarifications from the CBDT. These representations are not new. They have been made for a while. Discussions have been going on. We now have a budget coming 1st February or whatever the early date in February. The CBDT's view seems to be, but we have only clarified what the law is. But the representations have been made to clarify or amend the law to really take care of these points. You had 1 month, the budget. You could easily have clarified that through legislative amendment. To say technically that, the committee can only comment, we are not lawmakers, everybody knows. But then why come out with a circular a month before an opportunity to clarify the law?
Well, actually, it was the timing. It is the timing, Mr. Kapadia. When it comes just a day before the Prime Minister says that people who benefit from the markets must contribute more, the whole thing looks like it comes to a plan. But quite clearly, it was not like that. It seems to be more a coincidence.
And Lata, just one point on this Prime Minister's comment. I mean, again, when you sit back and, really think about that comment, it could mean two things. One is it could simply mean a reiteration of the fact that, we have had cases where there have been dealings in penny stocks where people have tried to, and therefore in connection with a larger debate on demonetization, you could say that the PM is saying, look, if you are really making genuinely money in the markets, which is taxable, then you pay for it. But the important point is which is taxable. Now, we don't expect the Prime Minister to speak technically on each and every aspect of the law. So it could merely mean reiterating the fact that please pay your fair share of taxes if you really made money on the stock market as the law requires you. That doesn't mean that the law is going to be changed to tax something else. That is how I would look at it.
So, Abhishek, I want you to come in on a couple of comments that Mr. Kapadia made. But before that, there's also lack of clarity on whether this is, retrospective in nature or not. Because theoretically, the government can levy tax retrospectively for the last 7 years, right? And that would be quite onerous. Do you think that revenue officials may demand tax for that long back?
So, as Sudhir said, the clarifications are only stating the position of law, and the law has been in force since 2012. In one sense, it came in 2012, although it is retroactive in nature. So clearly, even if the taxman doesn't go after cases pre-2012, I think from a timing perspective, clearly in my mind, this has been done in a sense to empower the tax officers to go after some cases where redemptions have happened, where offshore transactions have happened. And there is where the, retroactive angle comes in. So it's not retroactive in so much technically because the clarification is only stating the law and the law has always been in existence. But as Sudhir said, the timing of this is rather perplexing because one wonders whether this is really setting the preamble for the tax officers to go after several cases where not just in FPIs but a lot of private equity funds have seen a lot of transfers between LPs and redemptions where funds have had successful exits. So I think all those kind of cases are really where the worry arises.
Exactly. I mean, I guess GAR would be another issue as well. The general anti-avoidance rules kick in on April 1st. And yesterday we had a few tax experts telling us that in the light of what the PM said, perhaps there could be more tighter interpretations of even the grandfathering. Have you got queries like that, Abhishek, from your clients?
We have, but I think, just to give you a little bit of my perspective on the FM and the PM's comments on the market taxation, I think in my view there's a little bit of patchwork that exists currently. And when I say that, what I mean is patchwork between how residents are taxed and how non-residents are taxed and how listed securities are taxed and unlisted securities are taxed. And I think this has, happened because several changes have been made in reaction to market demands, in reaction to market situations, in reaction to how the, economic situation has been. And I think what will be certainly worthy in this year's budget, if time permits, would be an overall articulation of the philosophy of the government. How do they want to tax listed securities? How do they want to tax unlisted securities? Do they want to continue with a differential system of taxation? Do they want to provide an arbitrage? How do they want to treat non-resident investors versus resident investors? Because today it's all a mix and match. When you talk about what happened on dividend taxation, for example, last year, where they introduced the additional 10% tax. Now that has been introduced only for residents and not for non-residents. At the same time, the capital gain rate of tax in general for unlisted securities has also been reduced for non-residents, but for residents it remains at the higher rate. So I think what will certainly benefit not just markets, but even a lot of the private equity and other private investment, which is actually quite material in current days, would be an overall articulation of the government's philosophy on how they want to tax it. The private equity report that came out a few weeks back has clearly articulated that even for AIF investments, the government should move to an STT regime. So I think some broader philosophy and directional clarification will be very helpful on this. Okay, but to your question, Lata, on the GAR aspect, certainly a lot of concerns around GAR in light of this clarification on indirect transfers and in light of what's been stated by both the PM and the FM.
Okay, actually, you have really expanded the contours of the discussion. We were worried about FPI, but as you point out, there are several instances where the domestic investor is at a disadvantage. Let me just get to final questions from both of you. From my end, Sonia has more. Have you got calls from foreign investors, Abhishek, after this flurry of tax-related talk and circulars? What's the general mood? After all, it applies to investments already made. Will it really impact investments forthcoming?
So I think many of these things have been in a sense factored in and priced in. So, you know, if we again go back to May this year when the Mauritius treaty was renegotiated and we had a withdrawal of the capital gains benefits, even that really didn't you know, materially spook the FPI investors, and the markets remained pretty steady. So I think many of these changes in that sense have been factored in.
Okay.
I think what worries the investors is perhaps, as Sudhir said, the lack of appreciation on some of the nuances on control, why they're hell-bent on staying with a 5% threshold, why they're hell-bent on a 10 crore threshold. So I think these are the facts where their inability to make a point of view, which in many cases is really a genuine point of view. I think that's what's causing worry, not so much the fact that taxes have to be paid, because to my mind that's already been factored in.
Okay, same question to you, sir, Mr. Kapadia. Did you get any calls? And do you get a sense future investment will be impacted at all?
So, you know, I would put it this way: as I was saying, the association of FPIs, if you like, have been dialoguing with the government for some time to get clarity on application of these indirect transfer rules, as I mentioned, for institutional investors at the back end. Now, let me give just two quick data points. One is you may have, and you do have, not may have, you do have sovereign wealth funds investing indirectly in the Indian market under FPI rules. You have educational endowment funds. You have pension funds. Now, we all know that the real corpus lies with these kind of institutions, much more than just individuals. And we all know that in all these cases, in the home countries, by definition, they don't pay tax, not because of because of the nature of their institutional structure. So what happens is, it simply is this: in any host country which levies a tax, it becomes a tax cost. All I would say is the threshold or the hurdle on an after-tax basis increases that much. Okay. Then you also have the foreign exchange exposure vis-a-vis the rupee. So all I'm saying is, in the world of investments, ultimately shorn of all emotions, it is about, am I going to get a decent after-tax, after-forex fluctuation return from an economy? And that is how I would decide on my allocation for that particular geography. Okay. And there I would urge that, you know, our lawmakers and our policy makers just sit back and look at it, as I said, sans emotions, to say that, you know, are we doing something which spooks that kind of, those kind of investment decisions? Because I doubt if we have reached a stage where we can say we don't need FPIs. I agree that we need FDI and long-term money much more. There's no doubt about that. But we should be a little more careful about these things as well. And that is what I would urge. And that is what, if you ask me, is what is, you know, really worrying the FPI. It's not black and white. It's not that money goes away overnight. But it is just that in the calculations, you have just increased the hurdle rate for investments in Indian stocks.
But Abhishek, will this new interpretation of tax on FPIs be easy to execute? Because, the various funds have multi-tier structures in which the previous beneficiaries are very hard to be traced. I mean, it's okay when a fund has a few investors, but some of these multi-geography funds have a whole host of investors. So do you think that it will be very difficult for the taxman to actually enforce this new, tax rule on FPIs?
So I think in that context, it's important to understand one of the changes that again the government brought about earlier this year when they came out with the calculation and the more specific rules relating to indirect share transfers. And one of the things that they introduced there was a reporting obligation on Indian companies to report to the tax department any change in shareholding anywhere up the chain. And the penalties for not reporting are very, very onerous, and so are the timelines. Just to give you a perspective, if there is a change in ownership, and this perhaps doesn't apply to an FPI, but in general, if there's a change in ownership resulting in a change in control or management, then the reporting needs to be done within 90 days of that event, whereas in all other cases, it needs to be done within the prescribed period from the end of the financial year. Now just think about the implications for Indian companies which have multiple FPI investors, and having to sort of determine changes that are taking place, as you said, right up the chain. There could be complex fund structures, there could be complex master feeder structures, as the circular itself acknowledges. So I think the whole enforcement burden, in a sense, has been brought onto the Indian companies. What particularly intrigues me is a particular comment in the circular where it has been said that these reporting obligations are too onerous, too much responsibility is being put on the Indian company. And the circular only says, well, these are new rules, let's wait and watch, it's too early to make changes. Now, I think that really goes against the whole ease of doing business mantra. If it is something which everybody is generally saying is too onerous, you're putting too much burden on an Indian company. Think of FPIs that have hundreds of investments that they're entering and exiting. The whole reporting mechanism is actually going to fail, in my view, and you're going to have again some sitting ducks who the government will make an example of to really show that they're serious. So I agree with you. I think enforceability is certainly a challenge. Even though you have automatic exchange of information, etc., it may not technically apply to some of the transactions at the fund level between two LPs and so on. And I think the government has really unfairly put the burden on the Indian companies as a kind of proxy to be able to enforce these changes. So I certainly see this as a challenge, both in being able to collect real taxes, but also in terms of how Indian companies will eventually comply with this obligation.
Point taken. That's another angle altogether. The corporate problem at a time when they have to even tackle GST and the confusion. This would be, increasing the load on the compliance officers, the tax officers, the company secretaries. The positive from what both of you are saying is that, in spite of all these tangles, you did see a lot of FII flow, as you pointed out, even after the Mauritius treaties were amended. So FIIs, if they are determined to buy, if there is an India growth story, these things have not deterred them in the past. And probably another positive is that the United States also has fought its election on the same ground, make taxes simple. So maybe we are not alone over there, we aren't outliers. Thank you very much, Abhishek and Mr. Kapadia, for joining us in this discussion. Perhaps